Hello, in this presentation we will enter a reversing entry related to unearned revenue into QuickBooks Online. We will have a comprehensive QuickBooks Online course soon, if not available yet. We also have a comprehensive Excel course which complements the QuickBooks courses and a QuickBooks Pro desktop version course you can find at the link below. Here we are on the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem. We're going to be looking at reversing entries, which are reversing adjusting entries. In order to talk about reversing entries and how they will work, let's first look at a report by going to the reports down here on the left side. We're going to go into the balance sheet report, so we will select the balance sheet. Within the balance sheet, we'll change the date range to that range that we are working on, which is 01/01/21/02/28/21. That is January 1st, 2021 to February 28th, 2021, and run that report. Now, when we do the adjusting process, those are going to be those adjusting entries at the end of a period at a cutoff date, typically being the end of a month or year, in our case, the month of February. So our cutoff date is February 28th. We're doing adjusting entries in order to make the financial statements correct as of the cutoff date. And in doing so, we have one specific goal, and that's to make the financials correct on an accrual basis. But we have another goal, of course, which is just to enter the data in an efficient way. And those two goals are often done by different departments, or at least in different cycles or processes. So once we do the adjustments, sometimes we might want to set up another process in order to allow those two processes to be different and not have the adjusting entries mess up the normal functioning of the accounting process. So for this, we have the adjusting journal entry that we're going to be working on. So we first need to know what the adjusting entry was and then reverse it. Now, the adjusting entry for unearned revenue, as we discussed when we did the unearned revenue adjusting entry, is a little unusual in that in this case, we're using QuickBooks in a bit different way than you might see in a textbook, the unearned revenue being something that we had to add in the adjusting process because we increased this and it's a liability account for this unearned revenue. And the reason we had to add it here is because we had put it in relating to a customer into a normal accounts receivable. So it was in a negative receivable here. And we pulled it out of the receivable and broke it out into a liability account. The reason we put it into the receivable account is because it kind of logistically makes sense for us to group up the receivables because then we can track it by customer. But it's not exactly correct on a financial statement basis. Therefore, when we correct the financial statements or make the financial statements, we should correct the financial statements by breaking out the unearned revenue. If we were working a book problem, then the unearned revenue typically is something that accumulates upward as we receive payments that we have not done work for yet. Then we do the work and we adjust the unearned revenue down to the work that has been done. So there's kind of two different types of issues that could be involved in the unearned revenue. In our case, we got a deposit from a customer and we entered that deposit as a negative receivable. In order to get a better idea of that, let's go to the customer balance detail report. So we're going to go back to the reports on the left side. We're going to go to the customer balance detail report and see what we have there. We're going to change the dates up top of that report to a custom date range, and that date is going to be the end of February. So we're going to make it 02/28/21, and we will run that report. So here's the report that we have. We've got all of our customers listed down here. And if we scroll down to the bottom, then we'll see what we're talking about. Here is the item. Here's our original payment that we got before we did the work. And before we did our adjusting entry, that's all we had. We had this negative receivable, which isn't correct because it's making our receivable go down by 300, and it shouldn't be. But what it should be happening is a liability should be going up by 300. We like to do that because then once we have the invoice, it'll match up nicely on this report by customer, and we'll see the customer invoice match up to the payment under string music, which is perfect. But until that happens, it's not quite right. Once it does happen, it will be right. So we did an adjusting entry to fix it here. So we did this and fixed it, and we said it's back to 0, and we made a liability of it. And so if we select that item, Here's what the journal entry looks like. There it is. Now, we need to not mess up the normal process. This is great. I'm going to close this back out for the financial statements because this number is actually the correct number. It shouldn't be $300 lower, and we should have a liability. But from back to the logistical standpoint, we would rather have an invoice match up to this amount and have this amount disappear at that point in time. So one way that we could do that is we can do what we call a reversing entry. We'll just reverse this exact journal entry as of the first day of the next time period, and that'll basically put us back where we want, meaning we got everything the way we want it as of the financial statement date, and then the first day after it, we're going to reverse it and go back to where we were at before we made that adjustment, which is not quite right, but will be right once we issue the actual invoice. So once again, let's take a look at this journal entry, and all we're going to do is reverse this. So we increased the accounts receivable, and with a debit, or we debited the receivable, and we credited the unearned revenue. Reversing it, of course, we will just do the opposite of that. We will debit the unearned revenue and credit the receivable, but we'll do so on the first day of the following month, March 1st. So let's close this out. Let's do that adjusting entry. We're going to scroll up top. We're going to go to this plus icon up top, and we're going to select the journal entry. So we're selecting the journal entry. And we're going to make this a journal entry as of the first day of the following month, 03/01/21. So that's March 1st, 2021. Now we are dealing with debits and credits here. We're not going to use a register even though there's only 2 accounts because one, we typically do use a journal entry rather than a register for these types of transactions. And 2, the accounts receivable account's a little bit tricky. It has a couple things in there that are a little bit tricky, including the fact that we have to include a customer, which kind of muddies the waters to use registers. So we're going to do a journal entry here. To do this, what we're going to do is say the accounts receivable is actually going to go down because we're going to say that we have a negative receivable. So accounts receivable is a debit balance account because it's an asset, and typically to make something go down, we do the opposite thing to it as what it is, which in this case would be a credit. So the credits typically go on the bottom, so that we'll stick with the convention here and put this on the bottom. It's going to be it's going to be accounts receivable. Accounts receivable will be the account, and the amount of the account will be 300. And it's going to be a reversing entry. Type in reversing entry in the memo. And then the debit, the top account or the debit account, is going to be unearned revenue. We already know it's going to be a debit because we credited the accounts receivable, but we also know that unearned revenue has a credit balance, and we need to make it go back down to 0, and the way to make something go down is to the opposite thing to it as its normal balance, which in this case would be a debit. So we'll select the drop down, and we're going to type in unearned revenue. So we're going to type in unearned revenue, tabbing over, that's going to be a debit. And then we're going to say that the name is going to be, once again, the description of reversing entry. Now the accounts receivable, we do have to have a name down here or it will not let us post it. And if we want to see what's happening on that subsidiary ledger, we do need the customer account, the subsidiary ledger being the customer balance detail. And I believe it was String Music that was the customer that we were dealing with. So String Music is our customer. Gotta have that on the receivable or it probably will not let us post. Not needed on the unearned revenue side because this account isn't applied to specific customers in the same way that a receivable account is. So let's go ahead and save this and then go to our reports and see if it does what we think it should do. So we closed out that journal entry and now we're going to go to the reports on the left side and take a look at the balance sheet first. So we're going to go to the balance sheet and see what we have. So let's look at our normal date range first. The dates will be from 01/01/21 to 02/28/21, January 1st, 2021 to February 28th, 2021, and run that report. We scroll down, we got that accounts receivable account, once again, the 11,274, selecting that item and scrolling down, then we will once again see that journal entry 10, in my case, $300. If we scroll back up and go back to the report summary and look at the unearned revenue side of things, we have the $300 still on the books. Now we're going to look at 1 day later, so we're going to go back up here and change the date. I'm just going to select the plus one time to go to February or March 1st, 2021, and run that report. And if we scroll back down, then we see the accounts receivable changing, $10,974. If we select that item, then scroll down, we should see the reversing entry here. And you'll note that that just basically pulls it back out. So we've reduced the total in the accounts receivable back down for that item, just basically reversing the exact thing that we put in the adjusting entry. Scrolling back up, if we look at the other side, going back to the report summary, and then scrolling down to unearned revenue, we then have 0 in unearned revenue. If we see the detail, then we can see the activity. The 300 went on the books at the end of the month, so that we were correct as of the cutoff date. And then the first day after, it was reversed so that it's back down to 0, and it's really being recorded in the accounts receivable as we had at the beginning, as is good logistically, if not completely correct, from a accrual standpoint. So now let's go to that one other report and check this out one other way by going to the reports on the left side. We want to go to the customer balance detail. And I'm just going to keep the dates here because it's going to keep all the activity. And so we'll keep all the activity, including through March. And if we scroll back down, we see then the original payment we had, and then the 300 adjusting journal entry, and then we had the reversing journal entry. And so remember what happened here. The payments, what really happened. Here's us getting $300 for a guitar we haven't yet produced, and so there's no invoice to match it to. Here's us reducing that in order to make the liability and bringing it back down to 0. And here's us, as of the first day of the next month, basically putting us back to where we started at so that we can run forward logistically correctly from here. And everything from this point is not quite right, but will be once we enter the invoice. Once we get the guitar and ship it, then we'll apply the invoice out here and it'll match up nicely and everything will work well.